glad to introduce the keynote lecture, Professor Elroy Dimson, and the title of the speech is My Reflection on Asset Pricing. The floor is yours.
Well, hi everyone. I'm not disappointed at the empty seats. I'm surprised at the full seats. I hope I can share some thoughts with you. I was asked by John and his colleagues for a title, and I wasn't sure at that stage. So I chose My Reflections on Asset Pricing. I did have something in mind. What I had in mind was to talk about the way my ideas have evolved and the experiences that had guided me as an academic. I actually put this down in writing, and bits of it have appeared in a publication, which I'll mention at the end. But as we reached the stage where I couldn't be confident that I would arrive, not through ill health, but through the difficulties of traveling over the last few days while there's been industrial action, which must rival that of a number of other countries that are represented here. So I put it all to one side, and I decided I would share something of a more researchy nature. It was triggered in part by me being asked, can I send copies of my slides? And I'd initially thought I'd just be illustrating what I talk about in a more Italian sort of way, and then what I'm doing now is going through some ideas based on the long-term data which I, together with two colleagues, have assembled and analyzed to guide us on long-term persistent relationships in the market. So it's still reflections on asset pricing, but it's kind of different, and I'll mention something a little bit later on. This story began for me at the end of the 1990s when, having produced some index series with a British sort of focus, we'd designed a 100 share index which became the FTSE 100 and eventually grew to being a family of indices which are much larger than the number of securities in the world. That had given rise to a small cap index which we'd produced, and then the suggestion was put to us, what about looking at other countries as well? And we'd done something very limited there, drawn a few comparisons with the US experience. But the outcome of this was to dream up an idea for a millennium study. It was going to cover 100 years and celebrate the new millennium. And we decided in the end we'd have 100 years of data on what grew to be 10 countries. So conveniently, 10 countries, 100 years, that millennium. And so from that, this privately published book grew, and we published with Princeton University Press a book called Triumph of the Optimists. Triumph of the Optimists because we looked at returns over the long term, and it was clear that the evidence on the equity risk premium could be extended both chronologically and also cross-sectionally. And that equity investors, the optimists of the stock market, had done very well and had completely left behind the more cautious counterparts that invested in government securities. So that's what we authored in 2000. But we had a cautionary note there, and this is what will start me off on looking at what we're talking about now. Investment in equities will remain risky, I wrote. The new century may herald continuing international terrorism, new diseases, threats of large-scale litigation and corporate liability, environmental disasters, and new pestilences as yet beyond our expectations. The counterparts of the world wars and the Cold War of the 20th century may be new wars on terror, wars on drugs, courtroom wars, and wars against the forces of nature. We didn't know what was going to happen, but this was a catalogue of things that might happen, and it turns out we were more or less right. So what I want to do is to take that forward, and we developed a database which, as I said, originally had a century of data for for initially 10 countries, and that grew. And so we've now got data on 35 markets that appear in what we call a yearbook. It's an annual update, a 250 plus page A4 size book. And so most of those have data beginning in 1900, and some of them have data that begins somewhat more recently, but still a long haul. 23 of them start in 1900. 12 we brought into existence just over a year ago. And then what we brought in was others, which I've colored in here, 55 where there was some equity coverage, and there are still some markets where we had nothing. 90 countries in total. That's the data set which we now have. Not all of it covers 122 years. And then we've constructed some composite indexes for the world or Europe or whatever. That's fairly easy to do now, working in common currency. And these markets have evolved over time, and so I'm going to dig into these. So these markets started out on the left-hand side of this chart with us collecting data for the UK, which was the largest market, labelled here with standard abbreviation for Great Britain. And then there were some other substantial, but not such large markets, the United States, Germany, France, and some others. They're color-coded as we go across. And you'll see in there Austria, which sort of almost disappears and then comes back a bit, that's AUT, and Russia, which disappears completely and then comes back. And then we've got some that are labeled on the right-hand side. So we've got a data set which covers all of these. These are the ones for which we have data from 1900 to date. The United States has been dominant over time. There is a danger in extrapolating from the US experience. And more recently, a number of researchers have come back with papers of the same sort of nature, exploring the long term. And there are small teams of researchers in Germany, in the US, and one or two other locations that are looking at long-term returns. So just to describe the data set that I'm going to draw some lessons from, it's me together with Paul Marsh and Mike Staunton, so Dimson, Marsh, Staunton. So we've got 23 markets where we've got all the data in terms of annual returns. This is not monthly or daily returns, but a complete history from 1900 to date. That complete history involves two countries where the market closed, so they're not continuous histories. But in another respect, we're able to bridge them over time. And then we added 9 more markets in 2021, and we've got 58 other countries. This chart goes a long way down and should really be projected vertically, but that doesn't fit. So we calculate excess returns, amongst other things, for countries with a history a little bit more than 1 decade as our cutoff. So we can look at things that we'd first of all examined, like the equity premium, over long periods or over shorter periods. And we can ask questions like, what has the return been on different asset categories and what lessons can we learn? And I'll try to draw some lessons from that. So here you can see the annualized US dollar return for each of these markets. Help? It's okay. And you can see mostly markets have an annualized geometric mean return of somewhere between 3 and 6%, 1 or 2 below 3, 1 or 2 above 6. And mostly these are single countries, but I've put in red 4 series. Italy, well, you wouldn't have chosen to invest in Italy overall this time, but there's other compensating factors for being Italian. And then you can see in the middle, WLD stands for the world in common currency. That's heavily influenced by the US experience, which is the bar on the right-hand side in red, and WXU is the world excluding the United States. Do I have to kick it? Is this doing itself, or is there somebody in a room at the back who keeps bringing it to life? No, it's me. So you can see equity returns, and then you can see what's happened to government bonds, and these series all run for 122 years except Germany, where we leave out the period 1922-23, when the return on government bonds was essentially minus 100%, so there's no continuous series. Austria also had a bad period. It didn't actually have anything going to zero. And then you can see Treasury bills or the nearest equivalent. So if you have a look at the equity premium historically, that's a part of the building block that we look at in the common approach to looking at long-term returns. For the world, excluding the United States, 4.5% in dollar terms, 6.7 on the right-hand side for the United States, and 5.3 is the annualized dollar return from the world index. So that's part of what we sort of use sometimes if we take a global perspective on estimating required rates of return. So the difference between the equity and the bond on the bill return is 4.6%, and the difference between the equity return and bonds is 3.2%. So those are the starting points, and investors have done extraordinarily well in equities looking back. But the use to which people put this data is intriguing. By law, German utilities have to use these Dimson-Stormson numbers. We thought we were just documenting a series. It's kind of odd. If we stop producing these numbers, I don't know what will happen, and I won't go on doing it forever. So regulated utilities in Germany are just one example of that. Other countries do different things. Australia, for example, uses Australia-only data rather than global data. Looking forward, our judgments would be for a lower premium, perhaps the 3.5%. Rather than the 4.6 that we've seen relative to bills. Maybe it'll be lower still. I'll talk a little bit about that. One of the questions that we've got asked is, well, how can you take these numbers, which are in different currencies adjusted for different inflation, and just look at them all together? And so one of the comparisons that we make is to look at real returns in local currency and in US dollars. They're both real. And there's a striking similarity between the two. The difference, the little grey bars, represents the real exchange rate, that is the inflation index adjusted exchange rate relative to the USD, relative to the US dollar. And that's awfully small. So over the long haul, the numbers that one might look at are not very sensitive to exchange rates. Currency, if you were a regulator taking a long-term look backwards to produce numbers that are to be used going forward, shouldn't get too hung up about currency. And the way people use these numbers is for estimating required rates of return, for asset allocation studies, regulated returns, and so forth. So here's what's happened this century. And so what you've got here is a plot of the real yield, that is the forward-looking yield at each month since New Year 2000 for countries that in New Year 2000 or shortly afterwards had inflation-indexed bonds. So this is the risk-free rate that you would use if you're focused on real returns. And the black line that's superimposed on top is just the average of all the colored lines. It's just a guide to the eye. And so when I started doing this, I also got drawn into guiding the Norwegian Sovereign Fund as to what they might expect by way of long-term returns from equities or from their portfolio. And at that point, you could get nearly 4% on average. And if you ignore the UK, which is the line which on the left is a little bit low compared to the rest, which reflected a rush to buy inflation indexed securities, probably fully 4% if you didn't touch the UK index-linked market. And so we had a fall from 4 to about 1.5% negative. It's an astonishing decline. And that's That means those falling real interest rates boosted real index-linked, inflation index-linked bonds looking forward. So we should expect lower real returns from bills looking forward. And the real yields on linkers, on inflation-linked bonds, may not yet have reached the bottom. I would have found it impossible to make a statement like that a couple of years ago. But who knows what inflation-predicted securities will yield looking forward if they are truly default-free. So this is the point at which I want to start asking some questions that people are currently focusing on to interrogate the long-term historical data and just look at the evidence historically on issues that are concerning people. So one of them is, well, real interest rates are really low now. What should we expect for the future? And so to do that, we've taken all of the years from 1900 forward and looked at the real interest rates to find each year as the return that year on treasury bills adjusted for inflation. So we have 2,445 non-overlapping country years. It's a lot of data. But they're, of course, in quite different conditions, different markets, and so forth. And we've then taken the lowest 5% of all of these years, and we've taken the next 15, and so forth, up to the highest 15, and then the final 5% to bring us up to the 5% of all country years which had the highest real interest rate. And so one of the questions which we then asked is, what happens in terms of returns if you buy long-term government bonds when short-term returns are very low? What happens afterwards? And these rates are quite sticky. And so what you find is that bonds over the following 5 years, non-overlapping, so you wait until you know what the Treasury bills gave you. A moment later, you buy and government bonds and you hold them for 5 years, averaging all of those observations. You can see on the left that if you buy when short-term interest rates are very low, subsequent performance is low. If you buy when real interest rates are high, subsequent returns are high. In other words, government securities give you a return which is kind of anchored on short-term interest rates. We can do the same for equities. And so you can see here that equities for the shortest, on the left-hand side of this chart, gave you a very low return on average if you bought at a time when risk-free securities of a short-term nature were giving you low returns. They still gave you a premium compared to government bonds, but the notion that the equity premium might flip, which some people have put forward, isn't really supported by history. And our take on this is that real interest rates provide a baseline for all risky assets, and that one must follow some sort of building block approach to estimate what you might expect for the future. So we've used that a little bit to deal with another question, which is what should people be anticipating as the return from investing in different bonds? And so we've thought about stylized generations. Let's talk about my aged generation, the baby boomers. So the baby boomers have been around since around the end of the Second World War or shortly afterwards. So we looked at returns since 1950 on equities and bonds and a 70-30 blend. And so you can see equities did very well, bonds did well, 70-30 blend, because you can't simply average the returns which are happening from the two. A little bit lower. You can look at Generation X, the world since 1970. You can look at the millennials world, of the world since 1990. And so you can see that in this millennium, or the early years of this millennium, the last couple of decades or so, you might have thought that if you had a blended portfolio, 70-30, 60-40, whatever, it would bring you in 3, 4, 5% in real terms. We're using US dollars as a currency. But where are we now? Well, if you were investing in government bonds, a generous interpretation, although we don't know exactly what will happen year by year going forward over the next 10, 20 odd years, would be barely any more than zero in real terms. And then we add on the equity premium that we've estimated historically, and you might get 2.5% as the sort of real return that you might anticipate from a blended 70-30 portfolio. Looking around the colleges in Cambridge, Cambridge has 31 colleges, they all do their own thing, and we have surveys, Oxford does the same thing, in which bursars of each college compare what their projections are. And my college, which is Gunville and Keys, is at about 2.6% as its projection. One college is lower still. Many of them are somewhat higher, but not a lot higher. But if you look around in the wider world, the real returns that are anticipated from different portfolio strategies are often wildly optimistic relative to what I put up there on the screen. So real interest rates remain low, and we're in a low expected return world. That's the situation we're in now. And nobody who thinks about this would want to be back in a high return world, because you've just got to ask yourself, what would have to happen to bond prices if the world looking forward is to offer a high return? So you wouldn't want to wish for to be in a high expected return scenario through the movement of prices, at least. So by the end of 2021, inflation had become a big issue. And so one of the questions that people have been using our data for and asking us questions on is about what's going to happen to inflation. So this chart runs up to the beginning of the current year. And you can see there have been high inflation periods, but we've had several decades in which prior to last year, things were very steady. By the beginning of last year, going back a year, we were at inflation rates which were the lowest ever, and then we were hit by all the recent events which we've been able to follow. So by the end of 2021, beginning of this year, the inflation rate, the 12-month inflation rate, averaged across all the countries with continuous histories, not just the US, not just Germany, countries that we read about in newspapers, average across all of them. The average inflation rate had moved up from 0.4% to more than 4%. And it's gone up a lot in the first half of 2022, still more. I just stuck to annual data for this. By the beginning of 2022, US inflation was running at 7.5%, and we thought that was large. In the UK, 5.5%, Germany, 4.9%. All these numbers have gone up some more. And so people are asking, what might we expect? This is a really difficult question. And for investment people, it's a young profession. Most of them cannot look back to their past experience and extrapolate from that. So they have to make wild guesses or maybe look at history to give them some guidance. So as well as showing you real returns, we can also look at different inflation regimes in the same way as I did before. So here we've pooled our data. We've got 2,558 country years. The reason for having a slightly larger number is that I'm going to look at bond returns and equity returns in the same year as the inflation figure. So we've got slightly more observations than the chart I showed you of real returns. Doesn't change the story. And so what we've done is to take all of the country years that comprise the lowest 5%, and then 15, 15, 15, etc., up to the top 5% to see what those returns look like. So this line just shows you what level we're at for the boundary between one bucket of of country years and the next bucket. And so you can see on the left, we've got about a third of all of our historical periods were ones where the rate of inflation was negative, and about 2/3 of all of these observations are cases where inflation was positive. So when people say we're in an odd circumstance historically, if you would be willing to approximate the current time as being inflation of around 0, then we've been above 0 2 years out of 3, below 0 1 year out of 3. Not perhaps so unusual. If you're willing to embrace looking at long-term history where inflation rates went through the roof for different reasons as compared to today, but it's still informative. So what happened in years when there was a very low rate of inflation? That's when you would like the in fixed income. And so you can see them doing well and doing better than equities. And on the right-hand side, you can see what happens when there's high inflation, and unsurprisingly, bonds are really bad news there. But overall, it's clear that equities are not an inflation hedge. If you look at the period when there's high inflation, equities are hurt by at that time. Equities have beaten inflation. They've beaten inflation because they provided a risk premium. That risk premium is a reward to market risk, but it's not a reward that's connected in any important way to inflation. And we've also looked a bit at what happens as interest rates move around. That's sort of a topical issue at present. So this chart again goes up to the beginning of 2022. And what we've done is to plot the US Fed rate from when those rates started to be set, which in the case of the United States was 1914, running up to the end of 2021. And you can see a set of diamonds up there, little blobs. You can see the dark colored ones represent a period before interest rates went up, and the lighter colored ones before they came down. Now, one of the interesting things is to ask what happens when interest rates are moving. They're cyclical, but they're not in a predictable cyclical pattern. If you look at economic cycles, those are constructed retrospectively. In other words, people decide after they know what's happened whether you're in an upward or downward cycle. And you can see over here nice little red dots. Oh, one place for it. Of mine. If you look up the top, you'll see at the point where rates were declining, but as you come down from a peak, it stops, and you have a little jump up. And all over the place, you can see this. We've done this impressionistically, so you can see the highs and the lows, ignoring jumping around a little bit. But if you want to examine what would happen if you try to play the interest rate cycle, you don't know what's going to happen. At any particular date, you know what has happened, and you have to form a judgment. So what we do is we avoid using the hindsight of the diamonds that are plotted here in different colors. Instead, what we look at is interest rate hike investing and interest rate fall investing. So interest rate hike investing means you invest the first time interest rates are hiked by the Fed, and we hold until there's a cut. And interest rate falls, we'd invest on the first cut, and then we'd hold until there's a hike. So this is a very simple rule, but it's one which you could set out 100 years ago to follow and see what the performance looks like. So that rule could have been followed. It wouldn't require you at any particular date to know what's going to happen in the end. And with us today re-entering a rate hiking regime, one question we can ask is, what does history tell us about rate hiking? So we looked at this. First of all, I'll show you the numbers for the United States, and I'll show you the UK. So for the United States, if you had invested in equities, after a fall in the interest rate, you would have got a rather handsome return of 9.7% annualized. On the other hand, if you had systematically ignored cases where there's a rate fall and you'd gone only into the equity market after a rate rise, you would have got a meager 3%. So in other words, there are these cycles. These are not arbitrage opportunities. This is not comparing one country with another, saying when you should be in one country and when you should be in another country. What it's telling you is the periods when there were differing returns. And so because I think the case for a building block approach to estimating returns is helpful, then you can also see here what the short-term returns were like. Now let's look at government bonds. If you go into government bonds after rates have fallen, you would have got 3.7%, but you would have got nothing, just about, if you'd entered after rates rise. Bills makes very little difference, and inflation, well, what you would normally expect to find is that you have a rate rise, and you do that to cure inflation. That's what's going on at present. And so you would expect to see that comes in the middle of an expanding, accelerating rate of inflation. That is what happens. Let me just show you the UK. Here's the story for the UK. If you invest after a rate fall, you'd have made 8.5%, 1.2% if you invest in equities after a rate rise. Bonds, it's a similar sort of pattern. Bills tells you rather less than inflation. Inflation is the same story as before. You try to control inflation by pushing interest rates up. So it's not surprising that inflation actually persists. So what you can see here is that a big differences between investing in rising and falling rate periods. We're now in a rising rate period for most countries. And so you can also see something in terms of how the equity premium varies over time. The difference between the return on equities and the return on bonds or on bills varies a lot with the position that the Fed takes. So we can look at these premia. Let's first of all look at the United States. The annualized premium of equities relative to bills, if you buy after a rate fall, it's big. If you buy after a rate rise, the equity premium is nowhere near as big. If you look at the equity premium compared to the return on government bonds, you can see a similar sort of pattern. And as for bonds relative to bills, the maturity premium in government bonds, you can see the pattern again. What about the UK? We can see something similar, but more extreme even than the United States. If you compare equities to bonds, again, the same story, and bonds relative to bills, again, it's only after the rates have fallen that you find that there's something worth going for. So let's have a look at the UK, my country. The premium of equities compared to risk-free investing, the equity risk premium, was earned entirely during easing cycles and not at all in the rest of the years. So the equity premium is episodic. Again, people don't think in those terms, but I think this raises the question as to whether one should be contemplating equity premiums that vary over time and vary with the situation in financial markets. I'll just show you very briefly. Volatilities are perhaps as you would expect. After a rate fall, you do that to make things better, as it were, and you find that that coincides with a period where equities are a bit uncertain. You can see that for the United States. And you can then look at the Sharpe ratio, and the story that I've shown you, if we adjust by volatility, is even more extreme. So after rate rises, volatility is somewhat lower, but the Sharpe ratio is much lower. So another question that we can look at is the question of international diversification. So I know we've got a bigger New York than Stanford representation here, that I'm going to address this question that Bruno Solnick asked a long time ago. He claimed that US investors could halve their risk by investing internationally, and subsequent commentary was that seemed exotic at best, but mostly the consensus was, and I'm quoting, was that it was irrational to put this forward. But the advice was heeded. He was not the only person to make this case, but he was very influential. And what happened if you listened to Bruno Solnick? US investors had 1% of their assets overseas in 1980. It's 20% today. US pension plans had 0 of their assets out of the country in 1974. It's 38% now. Now, this was not all one finance professor. It would be nice if this is something which those of you who are here on the PhD colloquium could look forward to, having quite so much influence. But investing abroad just got easier and cheaper. So a question that we also asked ourselves with this data is, if we confront the historical data with what people did, have Americans benefited from the world diversifying internationally? And so, again, we've taken this data. There's lots of different ways we've sliced this data on different topics, but on diversification, we've looked at complete countries, not simply within countries. Bruno Solnick had looked at a relatively small number of securities, but individual securities across countries. So here you can see what the equally weighted risk was, equally weighted volatility, if you had a one-country portfolio or anything up to 21 countries. And you can see that the risk of the average country was 29.3%. It's a big level of volatility. It's big because we're giving as much weight to a little country as we are to a large country. And it fell a lot. If we were to capitalization weight these numbers, we'd see the pattern over there, which is sort of similar, but coming down just a little bit lower in terms of volatility. Nobody would think of international diversification in terms of the equal choice of a little country or a big country. So what we've done is to take the US first, anchor on the US's volatility, 19.8, and then brought in other countries after that, cap-weighted, till we've got all the countries in there. And so you can see the same sort of pattern, but there's a somewhat smaller benefit from diversifying. So there's a valuable risk reduction from diversifying globally, but perhaps not as much as Solnick believed to be the case. And so we've played around with some of these things, answering questions that people are putting to academics. Should you diversify globally for a US investor? Well, perhaps the right starting point for this is not to go all the way back to 1900, but to go back to the Bretton Woods agreements and free or floating exchange rates. And so you can see here that what the Sharpe ratio looked like for a US investor. And if she or he were to go global, there would have been a lower, not a higher Sharpe ratio. If you started in 1980, it would have been a similar story. If you started in 1990, it would have been a similar story. If you started in 2000, it would have been a similar story. But if you had hedged, you would have had less of an extreme difference between the domestic and the global portfolio, but pretty similar for the global portfolio as for a hedged global portfolio. What's happened over the entire 122 years, it doesn't make a huge lot of difference compared to the large differences that you can see for recent decades. So Solnick's advice didn't pay off for the period after you could invest globally with floating exchange rates. But why is that? US returns were exceptionally high, US risk was relatively low, and those two played together, delivered a favorable Sharpe ratio for Americans. So we've looked at this in a number of different ways, and to ask the question, what happens if we don't focus just on the US experience, which is the way much of the research looks. We've got 32 markets here, and so you can see those where unhedged or hedged, there was an increase in the Sharpe ratio or a decrease, and you can see a small number sticking down, and you can see a larger number sticking right up. On balance, if we look at all the different countries we might have as the home market, you can see that the United States is there towards the left. It's the third country in. But for the typical country, one's advice would be to diversify and to regard America as an exceptional country. So looking forward, it's worthwhile diversifying globally for almost all countries, but it's not guaranteed. And you can make a good decision, just like Solnick did, and the outcome can be favorable or unfavorable. But when home markets are concentrated, it obviously pays to diversify when you've got some markets which are largely invested in just a handful of industries. Let me share a bit on correlation coefficients. Then I'm starting to worry a bit about time. One of the things which we looked at is how correlations have moved. And so here we've taken data from the 1870s to the beginning of this year and looked at the correlation between the US and UK, between the US and Germany, US and France, and so forth. And a horizontal line represents the average. Over recent decades, post-Second World War, you can see the correlations between different countries. Here are the four big countries that we're identifying, France, Germany, Britain, and the United States, have crept up, although for a long time they were quite low. So higher correlations as markets became globalized. And I think I'm going to skip a little bit here. You can come back to me with questions. So I'm just going to jump through to a bottom line on correlations, and then you might want to pay me back. So what do the correlations between different equity markets look like? So one of the questions that we've been asked quite a lot is, does diversification let you down when you most need it? And so here is a plot where you can see what the average correlation between markets was based on 60-month rolling correlations going ahead a month at a time, post-Bretton Woods. And you can see a number of global events there. Stock markets have moved more closely during periods of turmoil. Typically, there's a short-term rise in correlations, but then there's reversion to the mean, and there's little impact on long-run investors. So my focus is much more on investing for the long term. Other people are interested in trading opportunities, but for the long-term investor, relatively little impact. So although flights to safety make bonds a hedge, taking a view on correlations for the long term when what you're reacting to is something which has happened in a short period is not worth a great deal. We've done a number of other things. One thing which people talk about is the value of emerging market securities and developed market securities. So here you can see, starting in 1900, what has happened to developed markets and what has happened to emerging markets. And you can see over here, you can see the developed market index. I can explain the composition of that shortly, and the emerging markets index. And you can see the same on bond indexes. Over the long term, emerging market equities and emerging market bonds underperformed their counterparts. Did they do that systematically? The big hit was in the 1940s during the Second World War and its aftermath. Since 1960s, emerging markets have beaten developed markets. But the person who says that the lesson of history is invest in emerging markets does not make a claim which would be supported by long-term history. So let me just look at why we called the short paper that underpins some of this presentation American exceptionalism. If we look back through the 20th century for major markets and major indexes, the USA wins. That's the block on the left. If we look at the 21st century to date, the USA wins. If you look at the post-global financial crisis, the US wins. If you looked at last year, the US has won. Over the long term, America has been exceptional. And the big question now, when some of these other markets are more troublesome to invest in, so if you wanted to move out of the United States, where are you going to put your money? It's tricky, because if you think that the record of America could continue indefinitely, you've also got to be rather brave. So we've written a little bit about this. I can send you this paper. And now I'm going to get back to what I was going to talk about with you. There's a book which has been produced by the CFA Institute, of which each person's won one of their prizes that talks about their own personal history. I've got a chapter in there. That's what I was going to talk about. Bud Hazlitt has done an excellent job on compiling these. It's free. If you buy it from Amazon, you pay less than €1 to get the Kindle version, but you get it for free on the CFA website. So that's what I would have talked about. There are also some references which are taken from the article. And I think that's the point at which I should stop, because otherwise I'm going to run dry, and I wanted to leave some time for questions. I don't know how much time we have for questions. Probably, please. Sorry, quarter round. 10 minutes. Well, anyone can ask a question, but there is a condition. You have to speak loud. I'm the only one that has a microphone. Yeah.
Thanks very much for that. That was very interesting. Can I ask you about
Yeah.
Are you trying to do up the basis of interest rates going up, what we're doing now? Does that, the way you calculate it, are you only going to the first rise? You're not doing each time a rise after.
Well, we don't look ahead to what's happening. So when there is a rise, we're in a rising cycle, and we deem ourselves to be in that rising cycle. If there's a further rise, or if they move, or if security prices move sideways. So we have a 100 and something of those changes in the chart that I showed you. We've done that for the UK as well. We're not looking just at the one time period in which the interest rate went up. We're looking at once the interest rate has risen, we deem ourselves to be in a rising cycle, and that is deemed to be going up even if it goes sideways. It's still not going down. So that's what we're doing. Can you hear at the back?
Yeah.
Good.
My follow-on question was, do you know when that excess return is actually, the higher return is earned? Is that earned at the beginning of the cycle, or is it earned halfway through the cycle? Is there a persistence going on that the return continues? Does that make sense, what I'm asking there?
Yeah, no, it's a good question. But what we have here is a century or so of data. We're slicing it up in different ways. So I'm showing you what the annualized returns are. This is not an event study. And there are people who've tried doing event studies in this area, and you could complement this. So what I've shown you is ways in which we can confront a data set with some questions. I think there's probably more that could be done. There's probably all the topics I've talked about have been looked at by people in the past, but could also be looked at fruitfully for doctoral students searching for another chapter to do with a readily available data set.
Okay, thanks.
we learned today that rates are key ingredient for performances of different asset classes and across different countries. A central question in macrofinance is what are the drivers of rates? You showed us a nice plot of different rates, short-term rates across countries, and we see this ongoing decline in real rates. There is the current debate on what are the driving forces of this interest rate decline. And there are two alternative main hypotheses. One is that it is determined by demographic factors. And another one is that inequality matters for this long-term secular decline in rates. What's your take on that?
Well, let's deal with, first of all, the structure of ages, the second, the question of inequality. And think about what happens when we look at investment markets. We look at them and then there's a surprise that comes along and the price reacts. There's a real problem with thinking about, for example, the demographic makeup of an investor population. Next year is going to be much the same as this year. So that kind of research is different in nature. I'll give you some caveats in a moment about what you might infer from what I've shown you. But I think when it comes to longevity or income inequality, next decade is going to be like this decade. You've got a very small number of observations that are truly independent. I think you could even raise the question with what I've shown you. When do these returns happen? And so I've shown you a pattern which is striking. We've done this not only for equities and bonds separately, we've done it for the, not only for the equity risk premium that I've shown you, we've done it for the value premium, we've done it for momentum, we've done it for the price of collectibles, musical instruments going back to 1900 and so forth. In every case, prices are responsive to the Fed rate or the equivalent in other countries. For the Fed rate, we have returns to the nearest day, and we can see what's happening to bond prices day by day. For some of these others, it's rather coarser because we've just got annual data on the returns of diamonds or violins, whatever. But it's consistently the same story. But this is all over the place, and you could easily select a 30 or 40 year period where what you think on the basis of 120 years will happen, and it doesn't happen. So these are not bets that one should take lightly. I think one should regard them as sort of suggestive of things that one might look at. I think one could also regard them as countering examples to people who claim something that isn't supported at all by the data. So I don't think this tells you a lot about demographics. We're looking all the way through at money and interest rates, but age structure, wealth or income inequality, I don't think this helps you enough. Can you tell me who you are when you speak, especially the person that's behind the pillar?
I'm David Feldman from UNSW Sydney. I'm not an empiricist.
Well, now I know who speaks. Who's got the microphone. Good.
And I was fascinated by seeing all the interesting variables, how they evolved and realized in recent years. What would you like me to take out of your lecture, out of your keynote address? What are the punchline you would like me to carry from here?
I think if you focus on, as the basis of the building block construction of expected returns, focus on short-term interest rates in real terms, that would be a big plus. Of course, when that's used in regulation, there are two sides. One side will rejoice and one side will moan that it's misleading. But I think in a world where interest rates are going lower in real terms, then that should tell us what we should expect for the future. And currently interest rates are getting lower in real terms at a very rapid rate because our inflation expectations are going up. The nominal rates are moving, but not very much. But if you take out inflation, we are back in what the British would refer to as the 1970s. That is when real rates become low because of the growth in retail prices. So the basic building block, I think, is very important. So the question being asked is, what would I recommend from an investor's point of view? And I think one has to answer that, first of all, by thinking about what the purpose is of investment. And so investment is often for the future, and it's for what you can spend your money on. For some of you, it might be spending money on education, perhaps of your children. That now looks relatively more attractive in a world where there's no payoff for you in terms of holding back from consumption. It has also made it more effective for those of you who like old automobiles, handbags, and other expensive things. The return in financial terms foregone by putting your money into those assets there's not much return that's foregone. So that means you should be willing to spend more, and that is exactly what has happened over this period. People have been willing to spend more and more on assets which shouldn't be thought of in financial terms, but if they are thought of in consumption terms, the opportunity cost of the money you're putting into old paintings or whatever it happens to be, that opportunity cost has moved, and probably has moved for the long term looking forward. Those of you who bought a really expensive and collectible car were very wise. Well, you're asking me about real assets and the question of what you mean by real assets. But if real asset means owning a home, the answer is yes. Yes, it looks more attractive. If you're talking about other sorts of assets, it kind of depends. If it's diamonds or whatever, who knows? That's a bet on income inequality, which is an earlier question.
Thank you. It was a very interesting comparison of international returns, and as you pointed out, I'm interested particularly about the American exceptionalism, which you apparently have an opinion piece. I would like to ask you, though, one thing I didn't hear the C word. Where is China? Which is, after all, something that happened in my lifetime, and as you can see, it's quite a while ago it started, but it's going on still, and I didn't see it in your, at least not with sufficient emphasis in your international
it appears in two ways. First of all, in the area chart that I showed you of the performance of different markets, China was there at the beginning, it's there at the end. And in between, when China vanishes, the proceeds, i.e. a 100% loss, works its way into the world index. Our world index is very small because the market capitalization of China wasn't that big. So that's the story on China. And I'm not really sure what more I can add historically. It's a warning that assets can disappear. They do not necessarily become valueless. So China was a well-endowed country, mostly the assets were not traded on markets, but the assets that were traded and that were nationalized over a number of years, but concluding in 1949, they didn't become valueless. They were just owned by different people. The same is true for Russia. So when Russia took control of businesses, it was a change of ownership. There are other changes of ownership, and I mean, when you start digging into the history rather than the numbers from these long series, they are somewhat depressing. So many people didn't benefit from their investments in Germany, even though in the end, Germany has done quite well in equity terms, but the investors may have been dead long before our series run through. So the world is full in its history of events like that. And if you were measuring our performance figures on different metrics, a more common question is, what does it look like after tax? That's one aspect. But if you're asking, what does the return of investors look like, rather than the return on investment, there's very mixed experiences, and some of those will be represented in the families that are in this room.
Yes,
I'll give you a more cheerful question.
Okay.
That really got me off on a bad.
Elroy,
bad
great to see you again after many years. Lauren Switzer
I
here.
can't see where you are.
Right here
Oh,
on your
right,
right.
right.
Okay,
Yeah.
great. One thing that was missing from the analysis was sort of the style nature of investments. You could say, yeah, and so far as for different countries, right, and each one of these countries has its own governance structure, and the nature of the actual markets are different. Norway would be the resource-based ones. So when, there's a certain diversification that you're going to get, and the benefits and the losses from just given the industry focuses of the different countries. But style things like large caps versus small caps. Some of the work has looked at this. There is some work out there that looks at this, the style changes, or the style returns over different parts of the business cycle, and default risk and all these other characteristics. So it's nice to look at returns, but when we're looking at an environment we're facing right now, and that's basically, if we're back in the 1973s, we're looking at possibly a very long and painful bear market, and that will have you covered all the grounds in the first book when you say, well, we're going to have wars, we're going to have plagues, we're going to have everything.
There wasn't a forecast. That was just
Yes.
the tongue-in-cheek forward in that book. Look,
So basically,
I've
some
stopped doing it.
thoughts
I've
about this.
travelled quite a lot. When you travel with BA, they have a record of where you've been in the world and how often you've been to different cities if you did it through their choice of airline. And the one that I've been to far more than any other is Oslo. And so when I talked to Norwegians, they have a range of funny stories, but one of the funny stories is of Grandpa, who left Norway, couldn't make a living out of whaling or whatever his business was, but went to America to become wealthy. And now Grandpa's children, the cousins, are asking whether there's any way to get back to Norway, the country with the highest GDP per capita in the world. So there are these changes of fortune, and there's also the question where you'd like to live. Norway would be a lovely place to live, at least maybe not in the middle of winter. But I think that there are factors that are important there. What happens if you're just investing in other countries? Sometimes, along the same lines I was referring to earlier, you can't get your money out when you want to. So there's exchange controls. And but sometimes markets are more difficult to trade in. You've helped me a bit with ancient data from Canada, and I don't even know where in principle you could get your money out, whether you've known quite how to do it and whether it would all seem too complicated. I've got some investments which have been there for decades in Malaysia. They were confiscated by the Malaysian regime, who then slackened, but you have to hire a lawyer to get your assets back. So even in more straightforward circumstances, there can be difficulties. So I have a lot of sympathy for people who have had a home bias in their investing. Americans have been very fortunate in doing that, but I also understand why people in other countries have stayed at home. They want to invest in something they understand and that they can access. If you care to contact me, if any of you want a copy of the article that I was drawing on heavily for this, I can send it to you. There isn't an SSRN version, but that's just because of the meanness of the publisher for that particular article. It's a practitioner article. But I can certainly send anything to anyone that emails me. I have just been appreciated. Okay, now what we're going to be doing is essentially calling all PhD students by name to step up forward to receive their certificate of participation. Once we finish with the PhD students, we'll ask our honorable children to receive their certificate of participation as well. And I'm going to be calling names. And when you hear your name, please step up to the podium to receive your certificate. Johannes Bach. Yes. Karen, one. Thank you. Shulhan.
Now it's the turn of our honorable tutors to step up forward and pick up our certificate. What is Virgin Miller? Is not here. Massimiliano Barbini. Lilian NG. Manuel Kemal Koçun. Juan Sotes Paladino. Here. Liang Feng. Antonio Melo. Antonio Melo. Valerio Flotti. Lawrence Ricker. I'll come your side, I'll come your side. Yes, it's better being downtown than here. Now I would appreciate if you all step forward so we can take a picture of speakers and students, including our honorable keynote speaker, Professor Elroy. Second way. Please come over. Where's Gianluca? Now we are setting section right from the top, going to the next section, right this way.
Okay. Good evening, everyone. Let me introduce myself. I'm Roberto Guida, the chair of financial economics here at Campus Biomedical University. I am very happy to be the co-chair together with Gianluca Mattarocci, professor at Tor Vergata University here in Rome. So I would like to thank John Ducasse, the president of European Financial Management Association, for allowing me to be co-chair of this event. And it is my pleasure to welcome you all on behalf of the dean of the university and all the faculty members of my university. So let's move on some other participants of the meetings. And I would like to welcome all the keynote lecturers and speakers we will have for the next 3-day conference, such as Douglas Cumming, Elroy Dimson, Giulia Paiaccani, Jesse Fried, Theo Vermeulen, as well as Tony Whitehead. So we received in the last few months over 300 papers which will be presented and discussed during our conference. We have more than 350 delegates. They are attending the EFMA 2022 conference, and we will have 85 parallel sessions, 5 plenary sessions, as well as 1 guest speak session at the end of the session. Taking into account the large number of papers we received, we finally divided them into 4 main areas, such as corporate governance, international finance, bankruptcy, and financial distress, as well as ethics and finance. So let me give you some details about the history and background of the university. My institution was founded as a private university hospital 3 decades ago. A new faculty were added to medicine and surgery, such as engineering faculty and food science faculty. The engineering faculty is investing in financial economics field, and this is the reason for which we decided to host this prestigious event. So let me give you some information about the venue and the transportation facility. We organize a shuttle service to the conference venue from the hotels listed on the website, and another special shuttle coming from the other hotels with the meeting points at the Laurentina metro station. The service will be available as a round trip every day early in the morning in order to reach the venue on time for the sessions. And at the end of the session, you will be the opportunity to go back to your hotels. So you can find the complete timetable in the folder you received during the registration. So the gala dinner shuttle service will be available on Friday evening to reach the restaurant just after the meeting ends. So let me give you other information about the dedicated areas you can find in the underground floor, the main conference hall where we are, and all the classroom for parallel session and the presentation of the papers. On the ground floor, you can find the reception desk, the access to the outdoor patio, as well as other classroom parallel session. So in the outside area, the outdoor patio, we will offer you meals and breaks for all the meetings. And you can find an help point on the ground floor just behind the stairs for your convenience. So the main conference hall will be dedicated to special events, as you know, special session, the award ceremony, as well as the keynote speech. So on Friday, a gala dinner will be held at Villa Appia restaurant in a suggestive environment surrounded by older Roman ruins, where you will taste a local menu. So the only things to say is wishing you all an enjoyable conference. Thank you so much.